Well, thank you for having us. My name is Paul Tomory. I'm President and Chief Executive Officer of Centerra Gold. And today we're here to talk about the company, why we think it's a compelling value proposition, and the prospects for some of our assets, as well as some commentary on the price of gold and other metals. So let's start with an overview of the company, where we operate. Some of you may remember Centerra as having been the operator of the Kumtor mine in Kyrgyzstan. That asset is now gone from the portfolio for several years, and the company has repositioned itself principally in the Americas, but also with an asset in Türkiye with the Öksüt mine. Our flagship asset is the Mount Milligan copper gold mine in British Columbia. It has as of right now, an 11-year mine life. We're working on a significant mine life extension, which I'm going to talk about. Also in British Columbia, we have the Kemess copper gold project. We're advancing a preliminary economic assessment there. In the United States, we have our molybdenum business, the Thompson Creek mine in Idaho, which we are reopening, combined with the metallurgical plant in Pittsburgh called Langeloth. And we also have in the United States an advanced exploration project called Goldfield, which is a gold project. I'll touch on that very briefly later on. Currently, we're rethinking what we might do with that. And then, of course, we have the Öksüt mine in Turkey, which has been a very substantial cash flow generator for the company, has several years of mine life left, and we think that it's been a very reliable performer. So I've spoken about our jurisdictions. Another hallmark of the company is our very strong balance sheet. We finished our last quarter with over $600 million of cash and a billion of total liquidity when you include our revolver. We have no debt, and I will speak to you about our project pipeline today, and I'll say right off the bat that we will be able to fund that project pipeline with our available liquidity. We won't need to issue new equity or new debt. The leadership team is relatively new. I've been with the company for just over 2 years. Ryan, the CFO, who's online here with us, has been in the position for about a year, and other members of the executive team are also relatively new. And in effect, we've taken a new look at the assets in the company over the past couple of years. We maintain a very strong dividend and buyback policy. We'll speak a little bit about that later, but we pay a consistent dividend and half for quite a while now, and we've been very active on our share buyback program. And in fact, we've increased the rate of buybacks over the last quarter, and we intend to continue that pace. So we believe that Centerra is a very compelling value proposition. On consensus metrics, we trade at 0.5 times NAV. It's a very low number, and we often get asked the question, why do you trade at such a low number? There are a number of reasons for it, and I'll talk about them now. And I think these also point to the value opportunity that is Centerra. And I should add that on some of our internal numbers, we think that it's an even lower multiple. On our internal numbers, we think it's a 0.4 times multiple. We trade at a discount for a number of perceived reasons. First and foremost is our exposure to molybdenum. There have been questions about why Centerra investing in reopening its molybdenum business. I'll come to that a little bit later, but we do think that there's significant compelling value in the molybdenum business. The assets are in the portfolio and significant unrecognized value. So there are questions about our metal mix. Now, on that point, I'll be very clear. We are a gold-focused company. Future investments, future development projects will be gold-oriented, and I will speak about those as the presentation advances here. Another point on the low valuation is 2-3 years ago, the significant cash balance may have been an asset, but now in this very high gold price environment, those who have had leveraged balance sheets have been rewarded because of the torque on the deleveraging aspect of free cash flows. And so our cash, which may have been viewed as an asset, say 2 or 3 years ago, today is probably viewed as more of a question mark. Well, what are they going to do with their cash? And part of what I'm here to tell you today is that that cash will go into our own internal development projects, as well as a continued shareholder returns program through the dividend and the buyback. So moving on, over the last 2 years, we've articulated our strategy, and our strategy revolves around surfacing value from our existing portfolio. We have a number of assets with a lot of metal in the ground, a lot of them with built infrastructure, with CapEx already sunk in them. So we have a portfolio of what I would call relatively low risk in execution brownfield projects, and that has been our strategic plan, is to daylight that value in the portfolio. We began with Mount Milligan. We came to an additional streaming agreement with Royal Gold that unlocked a future potential for the mine, and we are investing accordingly in both exploration and project studies to extend the mine life. I'll come back to that later. In the case of Öksüt, we've had very significant cash flows over the last few years. I'll touch on that in a moment. In the case of the molybdenum business unit, we took the Thompson Creek mine, which had been on care and maintenance and headed for a costly closure, and we've come up with a plan to reopen it, have a significant cash flowing mine that operates in vertical integration with our metallurgical facility in Pennsylvania, and a very compelling business case. And most recently, we've taken the Kemess asset, which has also been on care and maintenance. We've announced a new significant copper gold resource on it, as well as the plan to complete a preliminary economic assessment on reopening the mine. What have we done so far? The Öksüt mine in Turkey has generated over $500 million of free cash flow since we restarted it a couple of years ago. As I mentioned, we have an additional streaming agreement with Royal Gold on Mount Milligan, and we will be releasing a study on mine life extension here in September, in time for the Denver Gold Forum. And as I mentioned, we have announced a restart of the Thompson Creek mine and a ramp up of capacity utilization at the Langeloth metallurgical facility in Pennsylvania. What I'll do now is I'll go through some of our assets, and I'll begin with Mount Milligan. Mount Milligan is our flagship asset. It is a very large copper gold porphyry mineralizing system with significant potential for exploration and mine life extension. You can see our production profile for last year with just over 160,000 ounces of gold, 54 million pounds of copper. That is roughly the production level that we anticipate for the next decade at that mine. You can see that the cost profile is in 2024 was a relatively low cost operation given the strong copper credit. And as you can see, it has significant reserves and resources of gold and copper, nearly 3 million ounces of gold in reserve and over 1 billion pounds of copper, with a significant accompanying mineral resource. You can see the numbers there on the page. And the study that we're conducting right now is looking at how to convert those resources to reserves. We are carrying out a pre-feasibility study. So let me give a bit of the perspective here. The mine has life until 2036 right now. So our reserves run out in 2036. But that mine life is capped principally by tailings capacity. In other words, in 2036, we fill up available tailings capacity. So this study that we're conducting, this pre-feasibility study, has been looking at adding incremental tailings capacity to accommodate further resources. We're also looking at a throughput expansion to increase the annual production of both gold and copper. And we're also looking at optimizations in the mine plan and also in the process plant. This study will be released, as I said, in September, just in advance of the Denver Gold Show. This slide here shows the cross-section, and let me explain what we're looking at here. The first pit shell shown on there is the current pit. The very next one to the left is the reserve life, and then the line immediately to the left of the reserve is the resource, and that's the subject of our PFS. And you can see even that resource shell still leaves an enormous amount of mineralization, particularly to the west and to the southwest. And you can see on the very left-hand panel there, the two axes along which we continue to see continued mineralization. So just to recap, we have a reserve life that takes us out to 2036. The resource life, which is the subject of our PFS, we anticipate converting that to reserve to add approximately 10 years of mine life. And then through our exploration programs, which will continue beyond the release of the PFS, I think that there will be mine life well into the 2050s here as we continue to convert inferred material to indicated, and especially as we identify mineralization near to surface, which would make an economic open pit expansion to the west and also to the southwest much more attractive. So big picture, this is a very, very large mineralizing system. We are very confident in our immediate ability to extend the mine life by about a decade. And then beyond that, we're very optimistic about the exploration potential to have an asset in British Columbia in a safe jurisdiction in Canada, producing gold and copper. Let me touch very briefly on British Columbia. British Columbia is very supportive of critical metals and minerals. It has recently established a Ministry of Critical Metals, and through the objectives of this ministry, they have identified a number of projects in British Columbia for expedited permitting. In other words, sites where there's an existing brownfield disturbance, where the extension of the mine life is economically advantageous for not only the province, but for local communities. And I'm proud to say that Mount Milligan has been selected as a project for expedited permitting in British Columbia. So we like the focus and the commitment that British Columbia has been making to mining, and we're very encouraged. And in fact, it's one of the factors that led to our decision to look at a reopening plan for the Kemess asset, which is north of Mount Milligan. So that concludes my comments on Mount Milligan here. And I'll just touch very briefly on our mine in Turkey. It will produce between 100 and 125,000 ounces until 2029. And then beyond that, we're probably going to have a heap leach tail of production. It's a very simple oxide crush heap leach mine, relatively low cost, although costs are drifting upward because of royalties, which are tied to gold price. And obviously, with the higher gold price, we pay higher state royalties. But we expect strong cash flow generation here at Öksüt until at least 2029, with likely a residual leach tail beyond that for a couple of years. Turkey is a great place to operate. The local technical and operating skill sets are of the highest standard. The rule of law is clear. Permitting is straightforward, and we really like Turkey as an operating jurisdiction. And certainly, the mine, as I mentioned earlier, has been a very robust cash flow generator for the company. So let's move on here to the molybdenum business unit, and this is the one that probably we have to do the most explaining about when we meet with investors and we talk to the market. And this gets back to the valuation discount I mentioned at the outset. Centerra came across the molybdenum assets 10 years ago with the acquisition of Thompson Creek Metals. The company bought Thompson Creek Metals to get the Mount Milligan asset. Along with that came 3 assets in molybdenum, all of which were in effect idled. The Endako mine in British Columbia, the Thompson Creek mine in Idaho, were on care and maintenance. Endako will remain on care and maintenance. Both mines have very significant remaining resources of molybdenum. And in the case of the Thompson Creek mine, we were likely headed to closure. In other words, there would have been likely around a $200 million cash outlay to close the mine. So the company was faced with the decision either to head to closure and crystallize a negative $200 to $250 million NPV, or advance a project on reopening it. And we published a study that showed an NPV of nearly 500 million. So the delta between the negative and the positive was 800 million. And it made a lot of sense to proceed with reopening the Thompson Creek mine. Let me touch very briefly here on molybdenum. Molybdenum is a steel alloying metal, and it is principally used to make steel stronger in applications that require high performance. So, for example, high temperature, high corrosion, high cyclic fatigue, etc. So it is used to make stainless and engineered steels that are used, for example, in liquefied natural gas, pipelines, drill steel, gasification, liquefaction facilities. It is used extensively in the nuclear industry. It is used in offshore wind and solar. And so molybdenum is often thought of as an energy transition metal because of its high degree of applicability in all manner of green energy generation. It is also used significantly in aerospace and defense. And although steel demand, for example, in China is soft and weakening, those steels that are engineered steels, these high performance stainless type steels, the demand for those continues to grow, not only in the West, but also in developing markets like China. So we often have to point out that, notwithstanding the fact that iron and steel are relatively weak right now, those steels that use molybdenum continue to grow as developing economies mature, and particularly in Western economies because of, as I mentioned, the applicability in a lot of these green energy applications. So that's a short side trip into molybdenum. We like the metal. Current price is currently $22 a pound. We greenlit the project at $20 molybdenum, and you can see on this page here the headline economics: 472 million of NPV, a strong IRR, and we're now about a year into that project, and we anticipate, if you simply fast forward the valuation model, when we're up and running at Thompson Creek in 2027, we anticipate first production. By that point, the capex will have gone into the project. The NPV of the molybdenum assets at a $20 moly price will be around $900 million at the $20 moly, and certainly right now moly is trending higher than that. The other reason that we like the molybdenum business here, again, assets in the portfolio, is the vertical integration opportunity between the Thompson Creek mine in Idaho and the metallurgical plant in Pennsylvania. Let me just explain very quickly how processing of molybdenum works. Mines produce a concentrate. Those concentrates are shipped to roasters that then produce the final molybdenum product that is sold to steel mills. And in short, at Langeloth, we produce a whole suite of molybdenum products, but in its most basic form, we make a ferromolybdenum product that is used in electric arc furnaces, which, by the way, are a growth area. And recently in the U.S., significant announcements have been made by both Nippon Steel in their acquisition of U.S. Steel, and also by Hyundai in the construction of, or in the investment in new furnace capacity in the electric arc area. And as I said, ferromolybdenum is the molybdenum product that goes into electric arc furnaces. And we also make a technical oxide, which is used in the more traditional oxygen and blast furnaces. Our end products are sold principally to steel mills in the United States and Canada. As you likely know, the Midwest, the Great Lakes region, still has quite a large number of operating steel mills. And the current U.S. administration has put a significant priority on increasing steelmaking capacity and preferencing the steel supply chain, the so-called Made in America solution. And the vertical integration of the Thompson Creek mine in Idaho and the roaster in Pennsylvania is very advantageously poised to unlock value in the current economic industrial environment in the United States. A quick touch on the aspects of the project. We're investing in a pushback, so it's a lot of material movement and stripping. The mill is there. The tailings are there. You can see on this slide here, it is a brownfield site. We have a significant sized process plant. You can see the conveyor on the picture, office buildings, truck shop. And so the project consists of principally capitalized pre-stripping, and then some money is invested in refurbishing the plant and getting the tailings ready for increased capacity. So it's a relatively low risk project, and we're about a quarter of the way through the spending, or slightly less than a quarter of the way through the spending. So let me move on now to the Kemess project. This is located in northern British Columbia, north of our Mount Milligan asset. It is also a significant copper gold porphyry system. In many ways, it's a mine that would look like Mount Milligan when built, similar production levels, similar production cost of sales, but most importantly to Centerra, it is not streamed. There is a modest silver stream, but the copper and the gold are completely unencumbered. So we would have, if we were to develop a successful mine here, we'd have two fairly significant multi-decade copper gold mines in a safe British Columbia jurisdiction. However, we have some work to do. We have a significant indicated inventory of nearly 3 million ounces of gold, nearly 1 billion pounds of copper, and just over 2 million ounces of inferred, with over 800 million pounds of copper. So as you can see, it's a Mount Milligan sized resource. And this resource that we published recently will form the basis of the preliminary economic assessment, which we are currently carrying out. So if we go to the next slide here, this shows the mineralized cross-section. A little detour into history here. This mine is a past producer. It operated in the late 90s, early 2000s, and then was shut down in an era of very low copper prices in the early 2000s. Several years later, Centerra acquired the junior that held the deposit. And Centerra's original concept was to build a block cave operation. And a block cave is a very capital intensive, long development timeline, relatively high technical risk concept. We shelved that. And what we're looking at right now is a much more straightforward open pit over to the left of the page here in the west, with a relatively low strip ratio, with a more conventional lower risk underground to pull out the higher grades, leaving behind for now the deeper Kemess East, the former block cave concept. So what we're looking at right now are what are labeled Nugget, Kemess open pit, and Kemess underground, but not the Kemess East deposit. And that is the resource that we just published. We're investing significantly in continued drilling to convert inferred to indicated, and we will be releasing a PEA at the end of this year. So let me just talk about the concept here. The concept, as I said, is to mine out the open pit, and the capital development would comprise underground conveyance, underground crushing, to take the material from the open pit and the underground over to the existing process plant. And on our title slide, we can show it later, we had a photograph of the site which illustrated the 55,000 ton a day mill, the crusher, the conveyor. We have a camp, we have an airstrip. Most importantly, we have an over 300 kilometer power line, which in today's environment would cost over $1 billion to build. So what we have here is an asset. If you were to build it from the ground up in today's conditions, the process plant, the power line, the airstrip, the camp, it would be a well over $4 billion project. It would be very high risk, high cost, but the advantage here is that it's built. And so the project here would comprise a refurbishment of the facilities as well as the development of infrastructure to convey material from both the open pit and the underground concept, which is located about 10 kilometers away, over to the process facilities. So we will be releasing a PEA at the end of this year that will outline the concept. But as I said a few moments ago, the goal here is to have a mine similar in scope, similar in cost structure to Mount Milligan, unstreamed, with a decade or more of mine life potential in British Columbia. That is our objective. So that concludes my remarks on our assets. Let me just touch on capital allocation here for a moment. Centerra has been known for its significant cash position. And as I said, there are some questions, and I think this contributes to our low valuation. Questions, well, what is Centerra going to do with that cash? Is it going to make an acquisition? And whenever there's the prospect of acquisition, there may be jitters in the market. Well, is it going to be a bad acquisition? Is it going to be a good use of funds? And frankly, over the last 7-8 years, Centerra's track record of acquisitions hasn't been great, and in large part, that's why there's a new management team. We're more focused on the opportunities within the portfolio. So the pillars of our capital allocation strategy, starting at the top right, we believe we have lots of opportunity in the portfolio between the Mount Milligan expansion project, the Kemess project that I talked about, investing in the molybdenum business, and even deeper in the pipeline, Goldfield in Nevada. We have organic opportunities to grow the business and to create a growth production profile, not only on gold and copper, but also molybdenum. We can afford all those projects with our current liquidity reserves. In addition to that, we pay our dividend. We've been aggressively buying back our shares, and we will continue to do so. And lastly, we do look at external opportunities. We have made investments in juniors. For example, Thesis Gold in British Columbia and the Kemess district. We made a placement there. We like what they're advancing. So we will continue to make strategic investments in juniors where we think it makes sense. But we're not likely to do significant M&A, mainly because any M&A target would have to exceed the hurdle of our internal Kemess project. And when you layer on the acquisition cost, Kemess stacks up very well against any potential acquisition we might make. And of course, acquisitions bring with themselves uncertainty risk. Yes, you do technical diligence, but there's always uncertainty when you buy something. And the assets you have in the portfolio are known much better and therefore lower risk. And as I said, Kemess stacks up very attractively against any potential M&A. And so largely speaking, our M&A will be focused on smaller bolt-on type transactions and opportunities similar to the equity investments that we have been making over the course of the past couple of years. So in conclusion, Centerra is a deep value play. We trade at a very low multiple. We have significant growth opportunities in the portfolio. First of all, as I said, Mount Milligan study being released here at the Denver Gold Forum, which will extend its mine life. We have the Kemess project where we're going to be putting out a PEA at the end of the year, which will demonstrate a concept for a substantial scale copper gold mine in British Columbia. And we are currently executing on the Molybdenum business unit in reopening the Thompson Creek mine. All of these are deep value. And as I said, importantly, we can fund these internally. Let me just make a comment here on valuation again. As I said, on consensus numbers, we trade at 0.5 times. Our market cap in US terms is give or take 1.5 billion. On a consensus basis, Mount Milligan is worth 1.3, 1.4 billion. And when you take out our cash, our enterprise value is just under $1 billion, and Mount Milligan is worth 1.3, 1.4. And then everything else in the portfolio you get for free. So we think we have a very compelling value play here. We don't need to raise cash. We can fund our growth opportunities internally. And we think it's an exciting time as we daylight these opportunities in the portfolio. So Jasper, those conclude my my prepared remarks. And Ryan Snyder, our CFO, is here as well. And we'd be happy to take any questions you may have right now.
Perfect. Thank you for an excellent presentation, Paul. I would actually start with if you could tell us about yourself and your career.
Yeah, thank you. I'm by training, I'm a civil and then a mining engineer. I did an undergrad and a master's. I worked in consulting engineering for a long time in both mining and heavy construction, mainly on the project development side. Did an MBA, worked in management consulting for a number of years, and then spent the bulk of my mining career with Kinross Gold Corporation. I was there for nearly 15 years, culminating as chief technical officer. So I led the Kinross's project development pipeline, plus all the technical areas. I joined Centerra because at the time the board of directors was looking for a more technically minded CEO, shall we say an engineer, mainly to do what we've been talking about here, the daylighting of value in the portfolio, taking a good hard technical look at the portfolio and what opportunities may reside in it. But in short, I'm an engineer, and I have spent the bulk of my career in mining and heavy construction, more on the project development side in mining, but also in heavy civil. Ryan, why don't you introduce yourself as well while we're at it?
Yeah, sure. Thanks, Paul. So Ryan Snyder, as Paul said, I'm the CFO. I've been at Centerra for a little over 3 years, been the CFO for just over a year. I'm a chartered accountant, so started at an accounting firm for a few years, and then have been in metals and mining for about the last 17 years, spanning all areas of the finance function and across precious metals, base metals, critical metals. This is my third time being the CFO of a dual-listed company, and so a lot of experience on the mining side and across all areas of finance.
So, I mean, you have already hinted to it, but you came in, Paul, 2 years ago with a clear focus on improving, Centerra's operations, improving and expanding Mount Milligan, and have a focus internally, I guess you could say that. But could you give us a rundown of Centerra's history previous to you joining, or previous to the management change, really?
Yes, I think this is a very important point, because I think that some of the conceptions that exist around Centerra are still influenced by its past history. Centerra was, in its conception, a spin-out from Cameco. Cameco, as you know, is a big uranium mining company, and it was prospecting and developing projects in Central Asia after the fall of the Soviet Union. And it found, among other assets, in Kyrgyzstan, one of the most prolific gold deposits in modern times, the Kumtor mine. Cameco developed that mine and then listed Centerra as a spin-off company focused in gold. So in its conception, Centerra is a child of Cameco as a result of its activities in Central Asia. That Kumtor mine, as I mentioned, has been, over the last 25 years, one of the most prolific gold mines on the planet, generating very, very significant cash flow. And for much of Centerra's history, it was associated with Kumtor. Centerra was Kumtor, and the cash flows of Kumtor are what built the balance sheet that we have today, and it allowed the company to make the acquisitions to diversify away from Kyrgyzstan. Now, I'll say that when you have a mine of the quality of Kumtor, it can breed a degree of complacency. I'm not saying it's easy mining in Kyrgyzstan, but the grades were very significant. The company generated a lot of cash, and it deployed some of that cash into acquisitions like Thompson Creek Metals, which brought Mount Milligan and the Molybdenum business unit into the portfolio. But I think before the last 2-3 years, those assets were not optimized. They had a lot of potential that had not yet been realized, and that's what we've been focusing on. And in part, those assets were under-optimized because the cash flows from Kumtor were so strong, and there wasn't really a need to optimize the other assets in the portfolio. The company also made other acquisitions. It bought Goldfield in Nevada. It acquired the Kemess project with its acquisition of Orico Metals. So a lot of the cash generated from Kumtor was deployed into the assets that are in the portfolio today, and also developing Öksüt in Turkey. So the cash was deployed from Kumtor into building the portfolio that we have today. It's a very long story, and I'm not going to get into all the details, but the mine was nationalized. Centerra lost Kumtor, and at some point we can get into a long discussion around the story of how that happened and why it happened. But the point is, it happened, and this was 3-4 years ago, and Centerra lost the Kumtor asset. And in the wake of that, what was left was a portfolio of suboptimal assets, meaning that they weren't performing to their potential, or they didn't have a story or a development plan that realized their potential. But the company also had a lot of cash. And I think that a change was made in the leadership team in recognition of the state of the portfolio, what the portfolio needed at that time, more of an internal focus, and just a change in the post-Kumtor environment. So one of the things that when we meet with investors, especially people who are new to the name, and perhaps some of the people watching here are new to the name, they may remember Centerra as being associated with Kyrgyzstan and the Kumtor mine, but we're beyond that. That happened before I joined the company. But I think it's an important point to point out that in many people's minds, that association remains there, and we're beyond that. This is a different portfolio now.
Perfect. Can you talk more about the team at Centerra?
Yeah, so I'll speak about the executive team. You've met here, Ryan and myself. Our chief operating officer just joined a few months ago. His name is David Hendricks. He was most recently senior vice president of operations in Nicaragua for Calibre Mining. He successfully developed that multi-asset strategy that they have in Nicaragua, and you see now that Calibre and Equinox have merged. Prior to that, he spent many years at Kinross with me. He worked in Africa. He was general manager at the Tasiast mine there in Mauritania, and he spent many years in Nevada running the Round Mountain operation for Kinross. And prior to that, he's a mining engineer, graduated from Queen's here in Canada, and through the early part of his career, had a lot of experience in Canada, the United States, South America. So he's a very seasoned operations executive, and over the last 3 months, he's made tangible improvements to how we look at operating performance at Mount Milligan. He's been very close to the team at Thompson Creek, assisting them in their ramp up and their mining rate, and getting them ready to be a full-fledged operation in 2 years. So he's been a great addition to the team. Other members of the executive team include Ilan Timpano. She heads the strategy and corporate development area, and she's been forefront on a lot of the deals we've done, most notably the additional streaming arrangement with Royal Gold, as well as some of the investments we've made in juniors. Claudia Durazio is our head of HR, supply chain, and IT. She's been here a number of years, and our longest serving executive is Yusuf Rehman, our general counsel, and he brings a lot of experience on Centerra's history. He also handles a lot of our public affairs, our government relations, and key external stakeholder relations. So that rounds out the management team. Also in our senior leadership team, I should point out Lisa Wilkinson, who you've met here, head of investor relations, also brings significant experience, having had the same role at Eldorado and TMAC before that. And what I would say in the investor relations area, as we've created a new Centerra, we've also changed the way we characterize the company, how we reach out to shareholders. And one of the things that Lisa has done over the past couple of years is, and this gets to the valuation point. We were held principally by gold funds, gold specialist funds 2 years ago, who wanted Centerra because they wanted that gold exposure. And a lot of them have exited the stock because, and I'll say it frankly, 2 years ago, before the big gold run up started, or a year ago, you would have been better off going to a pure gold company, one that didn't have the molybdenum assets, if you wanted that torque and that immediate leverage to gold. Now, those companies have run. They're now trading at 1.1, 1.2. And what Lisa has done over the last couple of years is, in a way, spearheaded the resetting of our shareholder base. We are now held more by generalists, value-focused generalists who see tremendous value, but who also want that upside to gold. Now, the other thing I'll say is that because we've lagged the GDX and the golds, we actually now provide significant leverage to gold as well because of our deep undervaluation, notwithstanding the molybdenum exposure. I should mention a couple other members of the executive team, the management team, who are new. We have Luke Jalcevac, who's our Senior Vice President of Projects. He is leading the project team and has built a project team leading the construction and the development of the Thompson Creek mine. And he has also led the studies for Mount Milligan and Kemess, and is also looking at perhaps what we might do at Goldfield in Nevada in this higher gold price environment. We've hired new people in exploration as well. Richard Adolfo, an experienced exploration geologist, heads up our exploration area. And one other person I'll point out is Karina Brino in British Columbia. We've recently hired her as our Vice President of External Affairs for British Columbia, given the importance of British Columbia, First Nations government, as we advance our studies for Mount Milligan and Kemess. So that's just a snapshot. There are other key members of the team. Our operations leaders at Thompson Creek and Mount Milligan are also new in the company. They've been doing a tremendous job for us as we get those mines on a trajectory to world-class operating performance. But we've built a significant, and I think this is the key point, there are a lot of new faces, a lot of new names in our management team, at our mines, in the corporate office, and we believe this team is poised to deliver on this growth platform that we've been discussing here.
So, what does the shareholder structure look like? I mean, split between institutional, retail. Do you have any significant shareholders that also, at least 5 or maybe even up to 10% shareholder?
Well, we have a typical complexion. I'm not going to get into individual names, but we don't have, what I would say is we don't have an active individual shareholder. Some gold mining companies have significant notable individuals as shareholders. We don't have that. We have a more typical mix of institutional shareholders and retail. We have what I would call as an average institutional to retail mix. We do have your typical large funds that you would see invested in commodities represented in our shareholder base. We have the indexers, the passive indexers who hold us in their index portfolios. And then as I mentioned, we do have more recently new names coming in who perhaps are more generalist in nature, but who like the gold angle and who really like the value prospects that we have, and who like the fact that we're buying back our shares. We see deep value in our shares, and that's why we're committed to the buyback.
But so in other words, no single group that is more active in trying to steer Centerra.
No, we have what I would call a pretty typical shareholder base.
So what does the financial position look like? You mentioned it, I think it would be good to repeat it. Cash position, working capital. Also, what is your access to debt?
Ryan, I'll hand that over to you.
Yeah, sure. Thanks. As Paul mentioned, very strong and stable financial position. At the end of Q1, $608 million of cash. We have a $400 million revolving credit facility that's untouched. So combined with the cash, we have $1 billion of liquidity, and we have no debt. So there's no debt outstanding that we need to worry about. In speaking about working capital, even if you deduct the cash, our current assets exceed our current liabilities. We have inventories at Landloth and Mount Milligan in some of our sites, as well as receivables. So a very strong financial position. And I think, to reiterate a point Paul made, that's what we're going to build the company around. We are going to use that financial position to build our projects, to try to grow Mount Milligan, and to do it in a way that doesn't dilute shareholders or bring in any debt or external financing on bad terms. And I think that sets us apart with the ability to do that without accessing the capital market.
Fantastic. By the way, what's the interest rate on the revolver?
It floats depending on various covenants. Again, we haven't drawn this in some time. It is about a 2.5% margin above SOFR. So it's pretty standard. Most of the mining companies in our range have very similar kind of interest rate structures. So again, it's floating. It moves with SOFR. But we haven't had to access that in the last little while. And if we do, that's a competitive rate.
And Ryan, why don't you talk about the interest rates on our deposits?
Yeah, and on the other side, we do a very good job of moving money around the world and investing to try to maximize interest. So again, with that large cash balance, we don't want it to sit idle and not make any money for us. We make about 4.5% interest on the cash right now. So generate in the range of $20 to $30 million given the year on interest on our cash, which pays for a significant portion of corporate and dividends and things like that. So it's good to make money on the cash balance.
So could you give us some kind of range on how much free cash flow Centerra is expected to generate this year, if everything but the buybacks, which I view as discretionary, is included? So dividend, exploration cost, restart at Thompson Creek, etc.
Yeah, I'll need to be a little bit careful on this because we don't guide free cash flow. I think we've always kind of stated that we expect the cash flow from our mines to cover the build of Thompson Creek and our corporate needs, and that's still true. So I think the way I would characterize it is the cash, both Mount Milligan and Öksüt are cash flow generating mines. They make good cash flow on an annual basis. We'll see that again this year. That cash flow will cover the build of Thompson Creek, corporate costs, exploration, some of the holding costs for the other assets. And then, as you say, Jasper, it depends what we do on a discretionary basis, whether that's continued buybacks, which we're committed to. We're continuing to pay our dividend, investments in equity investments in juniors. But I would say, ignoring the discretionary stuff, our free cash flow from our mines can cover the rest of the needs.
And how sensitive are your free cash flows to changes in gold and copper prices? And how does it... is it a lot more sensitive to gold, for example?
Yeah, it depends what rate you want to use. For every $100 move in gold price, our cash flows change by about 15 to 20 million. So as gold moves up, we obviously generate more cash flows at the mine site. About a 10% increase in copper price has a similar impact, about $10 to $15 million on cash flow. So we do benefit from the increasing metal price environment. People talk about gold, but copper is up quite a bit this year as well, given what's happening in the world. And I think we've done a pretty good job of holding our absolute costs pretty stable at our sites. When we look year over year, Milligan's absolute costs are pretty in line with the previous years. There is a little bit of inflation in Turkey, but our costs are in line with what we've got into the market from an operating cost point of view. And so we are benefiting from that margin expansion that everybody's looking for as metal prices go up. And so that's a good thing for us.
So Q1 was a weaker quarter for both Mount Milligan and Öksüt in terms of production and also consequently unit costs. Could you explain why, and also how do you expect coming quarters to look like?
Well, I'll talk about the physical situation at Mount Milligan, and Ryan can comment on some of the cost numbers. At Mount Milligan, we've been mining in an area that has been reconciling poorly. It's a contact zone, and as a result, we're not quite getting the grades and the recoveries that we were hoping to get. So it's an area that has been problematic. Now, that area is spatially limited, and as the months go by here, as the quarters go by, we will be getting into more reliable material. So the Mount Milligan has been impacted as a result of mining in an area that has a limited area that has performed not as expected, particularly on the grade and the recovery side. And of course, that then has an impact on where we're at versus the guidance.
Yeah, I think the answer is it is all denominator driven, as Paul kind of pointed out there. With the lower production numbers, that's driving up your unit costs. Again, if you look at what comprises your all-in sustaining costs, operating costs, sustaining capex, and royalties, I would say operating costs and sustaining costs at both Mount Milligan and Öksüt are more or less in line with expectations and in line with what filtered into our guidance to the market. And so the increase in unit costs is denominator driven for sure for Mount Milligan. At Öksüt, I mean, there's a pretty large royalty that's paid to the government in Turkey that moves with metal prices and is variable. And so the higher gold prices are leading to higher royalties, which is pushing up your unit costs a little bit. But I mean, we're benefiting from that on the revenue side. So what we're gaining on the revenue side from selling at higher gold prices far outstrips the impact on unit costs from royalties. So I would say if there's any concern on unit costs, it's tied to the production number. And as we try to improve the production metrics, the unit costs will move down.
Perfect. So let's start with Mount Milligan, your flagship asset. Could you explain why the amended streaming agreement with Royal Gold, or explain the amended streaming agreement with Royal Gold and why it's crucial for extending the mine life and also consequently investing in Mount Milligan?
Yeah, that was a foundational objective for us. I've already covered about how big the Mount Milligan deposit could be, or how big the deposit is and how long the mine life could be. The terms of the stream were, it's one of the largest gold streams out there. And even for Royal Gold, this Mount Milligan the Mount Milligan stream is probably their most important asset. Now they just announced a deal. I don't know what that does to their portfolio complexion, but prior to the deal they just announced, Mount Milligan was the largest asset in their portfolio. The stream was. And as the mine had potential for mine life beyond 2033, 2034, 2035, it required capital investment. And given the economics of an investment, there wasn't an incentive for Centerra to invest in exploration and studies and engineering and permitting and all the work that goes into a significant mine life extension. And so Royal Gold has been a great partner. I mean, their money funded the mine in the first instance. And like they did at the very beginning when the mine was built, they saw the opportunity for a win-win situation here, a significant mine life extension. So we entered into an additional streaming arrangement that gave Centerra a significant incentive to invest in extending the mine life. And that's what you're seeing here is the PFS that we're going to publish in a couple months is in a way the first fruit of that additional streaming arrangement we entered into with Royal Gold. In its most basic, we paid an amount of consideration in exchange for a couple improvements in streaming terms. Ryan, why don't you just talk about some of the numbers involved in both the consideration and the improved streaming terms?
Yeah, sure. So, the amended streaming arrangement essentially changes the stream twice. So at two different points in time, once around 2030 and once around 2035. We paid 25 million of cash and then pledged in aggregate 50,000 future ounces of gold to Royal Gold. 33,000 of those are coming to us from our sale of our interest in Greenstone. So that kind of flows through Centerra and doesn't come out of our production portfolio. And the rest come after 2030, so fairly long dated. So that total consideration package was about $100 million on a fair value basis. But what happens with the stream, Mount Milligan, there's a stream on both the gold and the copper. The percentage that is being streamed is not changing, but the amount they're paying us for the streamed ounces and pounds is. And so for gold, right now we get paid on the streamed portion, $450 an ounce for gold, which is going to move up to $850 an ounce and then $1,050 an ounce in 2035. And on the copper side, for the streamed amount, we're paid 15% of spot price, which is going to move to 50% and then 66% of spot price. So as we get to the future world, 2035 plus, there's a big change in the economics to the Centerra side. I think there's a lot of numbers that I threw out there, but to distill it down, if we were in the new stream terms over the last couple of years, it would have been an extra $40 to $50 million of free cash flow to Centerra on an annual basis. So a big change in the economic sharing going forward, which does, as Paul said, incentivize us to look at this mine out into the future because the economics make sense for Centerra in those future years.
Awesome. So let's talk about the optimizations that you have and are carrying out at Mount Milligan.
Yeah, so a few moments ago, I mentioned the fact that we were not happy with performance at Mount Milligan. The asset had opportunities for improvement in the mine, in the process plant, in cost management, and in how we looked at and how the company looked at the future. So a year and a half ago, we launched a program that we call M+, Milligan Plus program, which looked at opportunities to improve the cost and the production profile at the mine. In conjunction with that, we have brought in a new general manager who's leading that effort. So, for example, there are many initiatives that are included in this program, but I can illustrate with a couple of examples. Number one, in the mine, we're looking at better cycle time optimization. In other words, better dispatching of trucks to shovels so that there's more effective production time. So in other words, trucks are rolling with rock in the box more often than before. So basic optimization in the mine. In the process plant, we're looking at smarter material selection and material processing. So for example, as the material changes in metallurgical characteristics coming out of the mill, so different parts of the ore may have different geological, geochemical, or geometallurgical characteristics. How you process the material in the process plant varies. You might want to have longer retention time in the flow tanks. You may want to apply different levels of reagent dosages, etc., different power to the grinding. We are focusing on an initiative that optimizes that mine to mill flow, so that we're working on improving throughput and material recovery through a better response to changing characteristics in the ore feed. An example on the cost side, we're looking at all of our key consumables that go into the mine: grinding media, fuel, lubricants, reagents, tires, for example, for the large trucks. And we're looking at better ways to procure and better ways, for example, to aggregate spending between Mount Milligan and Thompson Creek. And we've had a number of wins in these areas as we procure better through more competitive processes and through more strategic contracting and procurement activities. So these optimization efforts are focused in the mine, in the process plant, and in the cost structure. And ultimately, our goal is to have these improved metrics lead into the optimization, which is the longer term optimization on a longer mine life, because your cost structure determines the physical geometry of your pit. And so our immediate operational performance improvement program does play a role in optimizing the very long mine life. One other aspect of optimization that we do is technical. I touched on the extent of the ore body to the southwest and the west. Part of our technical optimization is more drilling to convert either material that is currently not drilled and classified as waste into mineralized material when we put drill holes into it, tightening up the spacing on some of our inferred drilling, moving it to indicated, and even in the more short term, focus on a grade control program where we drill several benches so that we have better visibility over the next 6, 9, 12 months of material, so that we can address the issues that we've been experiencing on grade and recovery that I touched on a little bit earlier. So part of the initiative there on the technical side is to invest in what we call a grade control program, but really it's near-term drilling to have better granularity and better visibility on material coming to the process plant. So these are just some examples among dozens of operational production and cost improvements at the mine.
And I guess you could characterize these optimizations as sort of the impact will be incremental. There's no sort of finished deadline when you all of a sudden will see a big impact.
Classic continuous improvement. So continuous maturation, continuous improvement in our processes. So yes, they are incremental, but in aggregate, they can be significant. And we've already seen some aggregate significant improvements.
Also,
for example, processing costs. I mean, if you look at processing costs per ton through 24 and through 23 into 24 and 25, you'll have seen reductions in unit processing costs. And that's through initiatives in the process plan.
Great. So let's talk about tailings capacity, which is a big factor here. You have tailings capacity until 2035. How much tailings storage capacity would you like to add, and what alternatives do you have for achieving that? Where to place it, in other words?
So, very good question, and this goes to the heart of the project. As I mentioned earlier, the reserve life at Mount Milligan is currently capped by tailings capacity. So, in other words, the current tailings dam will reach its maximum practical engineered extent in 2036. So, as part of this PFS, we are looking at constructing new tailings capacity, and there are several potential locations for a new tailings dam. In fact, they were identified in the very early stages of the very first feasibility study when Mount Milligan was developed. And we've advanced those concepts. And in this PFS, we're going to be essentially showing where that new tailings facility will go. And it'll be immediately adjacent to the current facility.
Maybe it would be good if you quickly could summarize the scope of the PFS.
So the most important part is the tailings. We touched on that. We're also looking at throughput expansion capacity. When you have a mine with 20 years plus, and ultimately we hope 30 years, it pays to have a look at capacity expansion. So we're looking at whether we can do relatively capital efficient debottlenecking type projects in the mill, and we're targeting a 10% throughput improvement. So that's the scope element number 2 in the PFS. Scope element number 3 is optimizing the mine plan itself, to have a more reliable blend of material coming to the mill, to have a mine plan that allows for more efficient use of the fleet and better unit costs in mining. And we're also looking at the potential for fleet expansion as you up throughput, as you look at a longer term mine life. Part of that simply is looking at a fleet optimization program. So those are the key elements: the tailings expansion, a throughput capacity expansion on the process plant, and an optimization of the mining fleet.
What is the plan post PFS?
Well, the plan is 10. So the plant's nameplate is around 60,000 tons a day. We'd like to take that up to mid to high 60s. 1,000 tons a day.
And is that something that will start right away, or?
Oh yeah, that's a good question. We could start on that project right away. So because the PFS will identify additional tailings capacity, if we increase throughput in the nearer term, of course we'll fill the first facility quicker. But if we start development of the second facility, that becomes a relatively easy matter. So absolutely, the throughput expansion won't wait for 10 years. We'll seek to implement that fairly quickly. So yes, you'd be seeing higher throughput and higher production levels for both gold and copper in the nearer term. I don't want to get too ahead of myself on the details of the study, but yes, I think that is a very reasonable assumption.
Permitting takes a long time, but luckily you have time to permit a tailings storage facility.
Yeah, so let me touch on that. I think this is an important point. The British Columbia government, there was an election recently last year, and since that election, as I mentioned earlier, the government has put in place a number of initiatives that are very mining friendly, or at least friendly to certain mining projects, and ones that are brownfields, ones that are already built. And the new Ministry of Critical Minerals, has been extremely supportive of Mount Milligan. We have a number of routine permits that we need to get right now to expand the current tailings dam, and we have been working very collaboratively with the permitting authorities on advancing those. And we're very confident, given the province's stance on copper and gold, on the importance of mining to the British Columbia economy, we are very confident that getting the permits for that tailings dam expansion are well within the reasonable expectation. We don't need the new tailings for, depending on throughput expansion, probably 8, 9, 10 years. And we're very confident that fits within the permitting timeline, fits well within that development timeline.
Awesome. And do you think that, obviously I think the PFS will be a quite high technical level, so with basic and detailed engineering, will you be looking to publish a feasibility study, or just go ahead with basic and detailed engineering further down the road?
Yeah, this is a PFS. This is, in the case of well understood existing operations where the scope of work is relatively well understood, what we're going to do here is we're going to put out the headline numbers around the PFS in advance of the Denver Gold Forum, and then following shortly thereafter, there will be a very detailed technical report that will show all the detail on production and tons and geology and metallurgy for what we hope is the 20-year mine life. certain elements of the project will be advanced to feasibility study. So, for example, the tailings, we're going to continue to do engineering work on the tailings post PFS, and there will be feasibility level study done on tailings. That's not something we're going to publish because that's more of an internal advancing the rigor and the standard of engineering on those elements. But from an investor perspective, the PFS is the main event. There will be advanced engineering in some of the subscopes, but those are not necessarily things that we would disclose.
And in terms of exploration upside, I mean, you obviously showcase this that you have resource, especially to the south, to the west and southwest. But could you talk more about how you look to explore the deposit and also regional targets for the next couple of years?
For sure. We're investing a lot of money in British Columbia exploration. Our two biggest focuses are Mount Milligan and Kemess and what I would say is that the exploration there is really focused on infill and extension, known ore body, known continuity, open along strike, open at depth. So it's really focused on delineating and extending known mineralization. So we have a very extensive exploration program at Mount Milligan, $8 to $12 million annually, focused on infill and extension. And what I'll say is that almost every hole comes up with mineralization. And on that cross section I showed earlier, in those zones to the west of the resource pit, in other words, to the west of the pit that takes us out to the 2040s, we are converting previously waste areas, because there had been no drilling, into mineralized areas, which of course helps future economics. So we continue to encounter mineralization. I don't want to say everywhere we drill at Mount Milligan, but we continue to delineate and extend the zone of known mineralization at Mount Milligan. And that's why I'm very optimistic that this mine will have life into the 2050s and maybe even beyond. And certainly if you look at some of the other analogous big porphyry systems in British Columbia, like Gibraltar or Highland Valley, these have had many, many decades of production. And it's not unreasonable to think that Mount Milligan will be similar to that. I'll touch on Kemess while we're on exploration. The program there is similar, very large mineralized system. And the focus right now is actually converting inferred to indicated. That's a higher confidence category. And we would like to get to a PEA that it has a greater proportion of indicated than currently. So the focus at Kemess has been delineating and infilling and improving the confidence and the knowledge of the current ore body so that we can have a more confident, more indicated-based PEA at the end of this year. In British Columbia, though, we are doing other drilling. We have agreements with juniors where we've got a project we're drilling in between Milligan and Kemess. As I mentioned earlier, we made an investment in Thesis Gold, who have a development stage project north of Kemess. And we're always in discussions with juniors who are proximal to our areas. One thing I'll say about Kemess is that Kemess is the key to a very prospective area called the Tutagon. Kemess is in a way the access point. We have the airstrip there, as I said, the power line. There's a camp that some of the juniors often use as a staging point to get out to their drill sites. And certainly from an infrastructure point of view, Kemess will be critical to unlocking any value or any exploration success that may come in that Tutagon district north of Kemess. So to answer your question, most of our drill dollars are spent on infill and delineation to get to better understandings of Mount Milligan and Kemess, and to ultimately have much longer mine lives there.
Perfect. Let's move to Öksüt and Turkey. So how do you expect the production and cost profile to look for Öksüt over the remaining mine life, which is 2029, right?
Yeah, Ryan, why don't you take the numbers and then I'll talk about how we look at the asset.
Yeah, so I think from a production point of view, you would know, Jasper, it's had a couple outsized years as it had built up inventories, so about 200,000 ounces in both 2023 and 2024. Our guidance for this year is kind of the normal Öksüt production range, which is 105 to 125,000 ounces. That's about the right annual number from now to the end of the mine life. Again, 2029 mining will stop. We expect there to be some residual leaching, so there may be production that spills into the 2030s, but we won't be mining beyond 2029. And you're looking at that 100 to 125,000 ounce range. From a cost point of view, I'll qualify this that it depends on metal prices. I think that the best way to look at Öksüt is if you look at, say, consensus gold, right? Consensus gold is 2,400 long term. Whether people believe that or believe it's going to be higher will be their own opinion. At about that gold price level, Öksüt is about a $1,500 an ounce unit cost mine. That's about the right number. Now, if gold prices go way up, your royalty will go up and your unit cost will move up a little bit. But again, that's a net benefit to Centerra. And so I'll just try to anchor it, given I'm not going to give a prediction on gold price. It's about a $1,500 an ounce mine at long-term consensus gold prices. That's the right way to look at it. And Paul, I think you wanted to add a comment on Öksüt as well.
Yeah, we like, I mentioned this earlier, we like Turkey as a country. We think that it's geologically very attractive. There are some very interesting deposits, and we would like to extend our presence in Turkey. So we are drilling at Greenfield sites in Turkey, 3 or 4 of them, and we would be open to other bolt-on type opportunities in Turkey. We have a great team there, and it's a presence we think we can leverage, and we're putting money to work in exploration in Turkey.
Fantastic. Are there any significant closure liabilities associated with Öksüt?
No, I wouldn't say significant, right? It's different than other jurisdictions where you're not filing a formal closure plan like you would in Canada or other jurisdictions. It's about $50 million US is our view right now. I think if you actually were to look at Öksüt, it's a very small, kind of efficiently run site, not a big footprint, no big tailings facilities because it's a heap leach facility. So you need to cover the waste rock dumps and drain the leach facility, cover it, and take down the ADR plant. But it's a fairly small closure cost for Öksüt, relatively speaking.
And is that paid over several years, or?
Yeah, it would be. It would take you a few years to close this down. So it's not a bullet on year one.
How easy is it to move money out of Turkey?
Yeah, it's not hard. Maybe a two-part answer. We don't hold much money in Turkey. When we generate cash at Öksüt, we move it offshore fairly quickly into other jurisdictions. It still stays within the legal entity that owns Öksüt, but we hold it offshore. And Turkey has a fairly normal annual dividend process. When you file your tax filings, you can dividend money out from the Turkish entity, which we do on an ongoing basis. So there's no real issue or restriction in terms of flow of money out of Turkey if you follow the normal process.
And are you currently conducting or involved in any Greenfield exploration project or other exploration project in Turkey?
We are, as I mentioned, we've got 3 or 4 programs in Turkey, early stage greenfields throughout the country. They're very early stage, so we don't share any results yet on those, but we're encouraged by the geology, and we will continue to focus on identifying opportunities in Turkey.
So let's talk about your molybdenum business unit. Could you just go over the business at Langeloth? How does it work? What margins do you get, etc.?
Ryan, why don't you take that? You've been very involved.
Sure.
Ryan also heads up our commercial area, so our metal sales and concentrate purchases area.
Sure, yeah. So, I mean, Langeloth is an interesting business, and I think when Paul was going through the assets, it's been run sub-economically, right? It's been running at about 11 million pounds a year of throughput through Langeloth. Its capacity is 40 million pounds, so you're not really utilizing much of the capacity right now. The issue right now is you're buying all third-party concentrates. So the business model of Langeloth right now, you buy third-party concentrates, you pay a price that is a discount to the market price of molybdenum for those concentrates, and the discount varies based on the quality of the concentrate you're buying. You upgrade that concentrate by roasting it and other processes to produce a suite of end molybdenum products, and then you sell those end molybdenum products from anything ranging from the market price of molybdenum to market price plus a few dollars of a premium given the product that you make. And so you essentially make a spread on the molybdenum that you buy and ultimately sell. But if you're only running at 11 million pounds a year, that spread times the 11 million pounds doesn't really cover all the fixed costs of the facility. So a roaster like a smelter or a refinery is a very fixed cost heavy business. And the way to make money is to have economies of scale and to fill that to a greater extent. And so our business plan around Langeloth is to fill it more. As we bring Thompson Creek online in mid 2027, that fills about another third of Langeloth, so 12 or 13 million pounds a year. While we're building out Thompson Creek, we are trying to ramp up Langeloth utilization to the extent we can. So moving to the 15 or 16 million pound range to try to, again, get those economies of scale. But ultimately what we see for Langeloth is trying to fill it to that 35 to 40 million pound range. That will spread your fixed costs. You'll make money just on that basis. But the other thing that Thompson Creek feed will allow us to do is because it's very clean, we can then buy more of the dirtier, lower quality third-party concentrates, blend out the impurities. You get to buy those concentrates at larger discounts at better terms, and that improves the overall economics of Langeloth as well. So when Thompson Creek comes online, it really does change how Langeloth can operate. You can also produce a few more of the higher margin end products with that clean concentrate as well. And so in between now and then, we are trying to ramp up utilization to the extent possible to move it from a slightly below break-even business to a beyond break-even and a positive EBITDA business. But really, the game changes for Langeloth when Thompson Creek comes on.
Awesome. And what do you perceive to be the greatest risk with the restart? And also, how will you minimize the risk of a capex overrun?
So, as I mentioned earlier, the project is relatively straightforward. 250 plus million of the nearly 400 million of the capital project is stripping. So that's mining activity. It's relatively low risk in the sense that it's just moving material and mining. If there's a risk there, it would be around ramping up a workforce, ramping up the equipment. We're refurbishing old equipment, but that's relatively straightforward as far as large capital projects in mining go. In the mill, the process plant, we have to refurbish some of the equipment, some of the motors, some of the pumps and the water lines, the slurry lines, and we also have to get ready for an expansion of the tailings dam. The mining rate, we are mining, so we've begun the pre-stripping. In the process plant and the tailings, we are still in long lead time procurement and final engineering. We will be heading to contracting and the awarding of civil works contracts and structural, mechanical, and piping contracts in the coming months. So you ask, what are the risks? The risks are ramping up the mining rate so that we get to ore in time for mid-2027. And then in the process plant of the tailings, what I would say the risks are normal execution level risks in mechanical, structural, electrical kind of work. But in the grand scheme of things, this is a brownfield reopening with a heavy stripping component. It is not an overly complex project.
Perfect. I think you mentioned you had almost, give or take, $500 million of MPV8 using $20 a pound molybdenum. How sensitive are the cash flows and also the MPV to changes in the molybdenum price?
It's of course, as with all metals, it's sensitive to the metal price. Once built, the asset will be resilient down to a $13, $14, $15 moly price. So it's reasonably resilient on the downside, and on the upside, it's quite torqued. We're going to be producing 10 to 12 million pounds of molybdenum a year. So every dollar is an incremental $10 million. And you may know that molybdenum is one of these metals that sometimes can go wild on a price spike. There have been spikes up to the high 30s, low 40s. And one of the things that gave us confidence in this investment is that we think that the molybdenum market is in a bullish phase. The global market is in shortage. The tariff situation coming out of the United States is potentially constructive in the sense that it creates a U.S. market for molybdenum. And we produce in the U.S., we roast in the U.S. Now, it has an impact potentially on some of the moly concentrates we might import, but in the case of Thompson Creek and Langeloth, we're confident in the supply-demand balance on molybdenum. We're very confident in it. We like 20 as a study price, but there is a potential for a significant price spike in the operating lifetime of Thompson Creek. Moly is principally produced in big copper mines as a byproduct. And largely speaking, those big copper mines, principally in South America, have been producing less and less molybdenum. All of the world's swing capacity over the last almost 7-8 years has come from China. So molybdenum is a growing market. Every year, the demand for molybdenum increases. It's heading to 700 million pounds a year. Over the last decade, the Chinese have been able to keep pace with bringing new supply on to meet that demand, but they remain a net importer, and there are questions around whether they can continue to ramp up capacity at these aging mines. As a point of interest, outside of China, globally, there are currently only 2 operating molybdenum mines, principal molybdenum mines, ones that produce molybdenum as a principal metal. Both are owned by Freeport, and both are owned in Colorado. Both are in Colorado. The third moly-only mine will be Thompson Creek. So the bulk of the world's moly comes from copper mines that produce moly as a byproduct, with a select number of principal moly mines, half a dozen in China, 2 in Colorado, and 1 being developed in Idaho. But anyway, all this to say is that in between the demand picture I painted earlier on molybdenum being used in engineered steels, growing at 2 to 4% a year, and what we see as a tight supply picture, we're quite constructive on the molybdenum market in the short to medium term here, meaning 2 to 7 years.
So first of all, so you have made it clear that Centerra in some way wants to divest the molybdenum business unit. What alternatives are on the table? And do you think you will have to wait until production?
We might. We want to make sure we realize significant value for our shareholders. We think the business is worth, as I said, 472 NPV8. Of course, CapEx gets sunk. That number is now well above 500 million. We wouldn't just give it away. It's just not the right thing for our shareholders. We believe that when the mine goes into production, there will be an IPO or a spin exit. It'll be an entity that generates cash. The CapEx will have been sunk. It will float on its own. So that is the ultimate plan, would be an exit at production. Now, given the constructive nature of the molybdenum market that we talked about here, could there be an exit pre-production? There could be, but we're not going to give it away. We want to make sure we realize value for our shareholders. Do we want 100% value? Maybe not. We might sell it at a slight discount, but we're certainly not going to give it away. And we're going to be patient on that. And, another point we make is the pressure to sell molybdenum is greatest now because it's perceived as a distraction. Once the mine is up and running and cash flowing, and the business is cash flowing $100 to $150 million a year, all of a sudden it's a different story. You might well want to hang on to that. But yes, our ultimate strategy is we are a gold-focused company, and we would look for an opportunistic exit from molybdenum at the right time.
Excellent. I think that exit would also include getting rid of Endako, or include Endako.
Most likely it would. It doesn't need to, but most likely it would.
And so, Kemess, could you tell us about the scope of the PEA in terms of production profile, throughput, initial capex, and all others?
Yeah, so I'm not going to really talk about numbers because we haven't released any of that publicly, but our objective, and I said this earlier, is to have a Milligan scale mine. So copper production similar to Milligan, plus minus, gold production similar, plus minus. The grades at Kemess are better, but it's a lower throughput plant. So on a production basis, it works out to about the same number. On a unit cost basis, again, plus minus, similar to Mount Milligan. So the scope of the capex is I suppose is the interesting part. The deposit that we're thinking of mining is located a little bit further away from the process plant, over a ridge in the mountains. So there would be a fair bit of capex involved in putting tunneling infrastructure in, underground crushers, underground conveyors, to bring the crushed material from the open pit, from the underground, over to the process plant. So that would be a good chunk of capex. That'd be not an insignificant amount of capex. Then there would be capex that would go into refurbishing the mill. The mill is a 45,000 ton a day mill. Certain components have been taken out and sold to other companies. It had 2 SAG ball mill lines. One of those lines has been removed and sold, so we'd have to replace that. And like the Thompson Creek refurbishment, there would have to be an upgrading of pumps, electrical systems, switch gear, etc. So there would be capex that goes into upgrading the mill. And the camp is old. It would need to be significantly upgraded. Those are the main elements of the capital. It would be the infrastructure for material movement from the deposits over to the process plant. It would be upgrades to the process plant, upgrades to the camp, and then, of course, fleet and ancillary type investments. So this isn't it would be a bigger capital ticket than Thompson Creek. This is a bigger project. It's a bigger mine. I don't want to put a number out there, but I will tell you it'll be a bigger number than the Thompson Creek our reopening capex.
And what is the plan or the next steps for Chemex post PEA?
We would, if we like the results of the PEA, we would move straight to PFS, more drilling, more advanced studies. There would probably be, very roughly speaking, 2 years of PFS and FS. In the case of Kemess, we would do an FS, and then a 3-year development timeline, permitting happening in the background. So a very rough estimate of first production would be 5 years, but a lot of that is contingent on what we see in the PEA, how the permitting environment evolves, how the engineering evolves. But very roughly speaking, PEA at the end of the year, 2 years of study, 3 years of development to get to production.
Great. And then Goldfield, you mentioned earlier this year you won't build Goldfield as a standalone project, and for everyone it's around, I think it's 700 or 800 ounces oxide project, heap leachable, in Nevada.
Yeah,
how will you crystallize shareholder value?
Yeah, I'm glad you asked about that. We did write it off. We did an impairment on the asset at the then gold price. We've done some further technical work. The deposit is not as big as we would have liked. We invested in some exploration and we didn't find as much as we would like. We added some, but not as much as we would have liked. But we've also done some good technical optimization work on reducing the potential CapEx, getting to good recoveries on a run of mine basis without having to crush the entire amount of ore coming to the leach pads. It's a simple flow sheet, and with gold at 3,300, we are looking at whether or not there may be a way to develop this with some creative structures around, say, hedging. So Goldfield, we're still thinking about it. We impaired it. We don't have a concrete plan to proceed with it yet, but we may change our minds, and especially in the light of the current gold price environment, there may yet be a future for Goldfield.
It's good to know. So then, could you talk, how are you thinking around capital allocation priorities with regards to investments in your own projects, M&A, dividends, buybacks, etc.?
Well, one of our key pitches is the cash we have is sufficient to develop all the projects we talked about. Build the Thompson Creek restart, expand Mount Milligan, build the tailings, develop Kemess, even potentially Goldfield. We have enough liquidity and cash flow generation to do that. And we will continue the buyback this year. We believe our shares are extremely cheap. We think that buying our own shares is one of the best uses of capital we can do right now, and we will continue to do that. M&A is a lesser priority because we have more than enough metal in the ground, more than enough built infrastructure at our assets to develop a compelling growth profile for this company with decades of mine life. So M&A is a lesser focus, and to the extent that we do M&A, it will be more on the bolt-on junior investment area than in, say, buying a producing mine or an advanced stage development asset. So, capital allocation is straightforward. We can afford we have more than enough liquidity to build our production profile, our projects, and to continue buying back and paying a dividend.
So where do you envision Centerra Gold in 3 years from now?
Well, that's the game. In 3 years from now, we hope to be up and running at Thompson Creek. We hope to have a 2-decade mine life plus at Mount Milligan, and we hope to be executing on a second big copper gold porphyry mine in British Columbia, and with a bit of luck, producing in Nevada at a Goldfield. And you put all those things together, that's a pretty compelling growth profile in gold and copper, and a clear pathway to strong cash flows in molybdenum. And the strong cash flow in molybdenum, you either accept the cash flow and take it, or you then use that as the carrot for a spin or an IPO. But that is the question. In 3 years, Centerra will have a very compelling story of two large mines in British Columbia with multiple decades of mine life, gold exposure potentially in Nevada, and then value crystallization in molybdenum. So I think it's a very compelling story on a value basis.